equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, if you are joining us for the very first time, welcome. If you're just getting up to speed, I suggest heading over and checking out our Get Started Investing podcast. But otherwise, we hope you enjoyed today's episode. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, for the interview that we've got coming up. We like to think globally here at Equity Mates. We like to think of ourselves as global investors. The global economy is certainly in the news, but too often global becomes a proxy for the US and maybe a little bit of Europe sprinkled in there.
Yes. There's
a whole wide world out there. There's a lot of companies to invest in outside of the US and Europe. And so we've got an Asian equities analyst in here to give us a truly global, well, a bit more of a global perspective today.
That's it. It is our pleasure to welcome to the studio Gary Monaghan. Gary, welcome.
Thank you, and thanks for having me.
So Gary is Investment Director of Fidelity's Asian Equities range and is here to help us unpack Eastern markets in a bit more detail. As you said, Ren, we're often very much tied to what's happening in the US, but there is plenty of awesome and interesting things happening in Eastern markets. We're going to have a look at what's driving them, where we can find opportunities, and a look at some of the stocks that demonstrate these opportunities in the Asian equities range at Fidelity. But Gary, new segment, which we're really excited about. It's called Equity Mates Biz Nerdle. Before we get stuck in, it's the Equity Mates daily guessing game.
Okay.
And we're going to put you up head to head against Ren. Now, he has already played this today, so he got this in 3 guesses, which is unusual. He normally gets it in 1, so it must be tough.
It was pretty tough today. Okay. Now, if people want to play along at home, equitymates.com/biznerdle, once a day, there'll be a new company that you can try and guess.
Can I put a request that if I do more than 3, can you edit it so it's 3?
Of course. We'll edit it so it's 1, Gary. Don't worry.
Okay, perfect.
Hoping that it's an Asian company. All right, clue number 1. My loyalty program is called Miles and More.
Next.
I was the first airline to buy the Boeing 747-8, the largest commercial aircraft built in the United States.
Oh, I've got a couple of companies in mind. Let's do the third one.
Okay.
Before I guess.
Okay.
It was tough,
Yeah.
I was founded in 1953 and my headquarters are located in Cologne, Germany.
Lufthansa.
He's absolutely got it.
Yeah, well done.
Correct.
Yeah.
So if you would like to play along at home, equitymates.com/biznerdle, I'm sure Gary will be doing that every morning before he heads into work.
Definitely. Get the brain ready.
Yeah. Take it back to your colleagues in Hong Kong. We want to see a big spike in Asian users. Yeah.
Now, can I do one for you two later as well?
Oh, yeah.
Yeah,
Sure.
Hey, we ask the questions here.
Gary, I think we want to start macro here because as we said in the introduction, the macro economy is in the news. We're talking, Silicon Valley Bank and Credit Suisse seem to be dominating the headlines at the moment. Before that, it was inflation and interest rates. Well, still is inflation and interest rates. But too often we talk about the US and we don't really get a full global picture of what's going on. So I guess starting broad, can you give us an idea of how these stories are playing out in an Eastern context in Asia?
Yes, it's quite interesting because you picked 2 things there that aren't necessarily such a big problem in Asia, whereas there's other things in Asia, right, with reopening, all these other things which are sort of a much, much bigger sort of impact for us. But if you're looking at the banks, for example, so SVB, which you used, if you just look at what they did, essentially, I won't go into too much detail because we could be here for hours, but they had an asset liability mismatch, and so they weren't really sort of hedging their interest rate risk properly, and they had a concentration of deposits as well. So as soon as a couple of clients, for whatever reason, needed to withdraw, you're getting a bit of a run on the bank, and it's, from our perspective, seen as a bit of a developed market issue, right? There's some regulatory failings there as well. But if you look at the banking system in an Asian context, one is a lot of the banks, for better or for worse, are SOEs, so state-owned enterprises. And so they've got full government backing at all time. And you're probably not going to do anything sort of too dodgy.
Don't Western banks have full government backings at all
Well,
times?
they do. Actually, what I was about to say, officially they do, but yes, officially the Asian banks sort of do, right? So they don't sort of tend to fall foul on these things. But the other thing is going back to the deposits and the concentration of deposits. If you just look at how the customer base is based in Asia, it's growing because the populations are growing. Demographics generally, not in China, but most other places in Asia are getting better. So you're getting more people moving into the formal sort of financial system. So you're getting deposit growth. And you look at someone like a HDFC Bank as an example, the biggest private sort of managed bank in India. Their top 20 clients or top 20 customers account for only about 4% of the total deposits, right? And so you don't have that same sort of risk. So you've got, in our minds, using banks that you talked about, it's not so much of a problem for us in an Asian context. And I'm not saying it necessarily, is it better or worse? Well, obviously, we think it's better, right? Because I'm coming at it from a biased perspective. But, we think that it's not sort of an Asian issue right now. And we're seeing this actually from a market perspective, that the banks haven't really reacted from a stock price perspective. And we're getting this sort of what we consider a flight to quality. And some of these banks are good. They're really well managed. So that's the banks. Maybe on your other one, interest rates, inflation. Again, inflation hasn't really bitten us in Asia, right? You look at China, Hong Kong, where I live, 2%-ish, inflation.
Wow.
A lot of that, though, because the cost of things like oil and energy just hasn't gone through the roof. There's been other avenues that they've been getting their oil and energy, and so therefore they haven't had the supply constraint and sort of the big issues that we've seen in the West. And so with that, we haven't really seen the tightening in the same way as well in terms of interest rates and such. Where it does impact is probably on the interest rate side, it impacts the US dollar. So people often think dollar strength equals Asia equity weakness. That to us is a bit of an old fallacy, but it still lingers in the back of the mind. And it's something that we sometimes use if there's a negative sentiment barometer, that dollar strengthens and equities go down. So it can be an interesting buying signal for us.
On the dollar story, the US dollar was incredibly strong last year.
Yeah.
There was, interest rates were going up there. Investors were moving their money into US dollars. But you say that that connection is broken a little bit. So how did it play out last year? Yeah,
well, just in general, if we go to why that connection is, so you go back to the Asian financial crisis right back in the 90s, I think it was like 97, and essentially what was happening to a degree anyway is that Asian companies, they didn't have the proper financial system as we see it today, and so they were borrowing in generally US dollar, but foreign currencies, currency moves happen, and suddenly you get a mismatch, right? You're earning in Indonesian rupiah and you've got to pay down in your dollar debt, right? You get hit quite badly. What we see right now, if you look at corporates, the banking system is improved a lot. There's some good banks across the region, and that same Indonesian company is probably borrowing in local currency from its local bank. So the dollar impact has less of a true sort of impact on the businesses that we look at. But of course, it's in the back of everyone's mind. And so that's where I say, when we see that, we're like, actually, that could be just a tactical opportunity to buy in.
What about the general economic growth picture of Eastern markets? We're looking at Western countries, pretty weak growth outlook. Is that playing out over in Eastern markets?
No, it's still pretty strong. So you're not going to get these sort of 8, 9, 10% growth rates that we've seen before, partly because you're starting from a higher base, right? You can't grow at that 10% per annum. I'd like to, and maybe doing that 100 to 130,000 thing you're talking about. You can get that sort of return. That's great, but from an economic perspective, it's hard work, and for us, it's just not feasible to be growing at those sorts of levels. But if you look at China. It's starting from a relatively lower base, if you like. It's not been very strong, but they're looking at 5 to 5.5% GDP growth, which in a global context is pretty attractive. And there are sort of policies that will be coming through to support that. What those are, we don't quite know yet. They haven't been announced. You may have seen I think it was last weekend, as we're recording this anyway. Last weekend was the sort of new, what they call two sessions. So it's like an economic sort of party congress committee sort of meeting. They've reshuffled the decks a little bit in terms of leadership in certain sectors, certain industries and government bodies. And the message that came from that is we're looking to support growth. We will be providing support. Again, we don't know quite what that means, but what you do know is that when those messages come through and they say things like we are here to provide support for private businesses, that it will happen. And so what tends to happen from a China perspective, you get these broad top-down messages and kind of people figure out how to implement it. And then for us, from an equity investing perspective, we know things are going to grow. And then you start to then figure out which areas are going to be focused on now. And that could be an interesting sort of place to buy into.
Yeah, right.
Well, we want to get to that conversation around China. And I think the largest holdings, the largest geographic exposure in your fund is China. So we'll spend a bit of time there. But just closing out the macro side of things, you mentioned that inflation and interest rates and banking collapses aren't as big a story in Asia, but you did say that the biggest thing was China reopening and how that affects the region. It'd be interesting to hear how you think that's affected the region and how you think it will play out. But also with China, the story that just seems to linger and doesn't seem to go away is this slow-moving property crisis. Is it a crisis still? Who knows? Evergrande, I think, today, as we're recording, reached some agreement with a number of their creditors. Is the world's biggest asset class, China's residential real estate, is that stable? And how's the reopening story going? Yep. Just give us a bit of more of a detail on China, I guess.
Okay, right, there's a few things to unpack there. So tap me if I'm talking too much or to get back on track. But if we look at the reopening, right, that's the thing that's really got everyone's attention, particularly in the last couple of months. China, as you know, had this sort of lockdown, right? You couldn't get in, it was hard to get in, it was hard to get out. And, from a corporate perspective, it's difficult to manage a business or work out how businesses are going when things are locked down. And, from a sort of a general consumer sentiment perspective within China, people were pretty down in the dumps, right? You just can't go out and go shopping and travel and all that sort of thing. So it had a huge sort of impact overall on the overall economy. And of course, it had an impact on sentiment as well. And sentiment's important. Because if people don't like China or they're concerned, then you're probably not going to own Asia. And in fact, you're probably not going to look too much into GEMs, global emerging markets, because China is the dominant force. In terms of size, in terms of the way it can influence sort of markets and such. So it had this huge impact, and you saw the A-share market in particular. So that's the mainland stock market in China that got hit quite badly. Foreign investors that can buy it were redeeming because they just didn't know what was going on. People at home within China, who are the biggest sort of drivers, if you like, of the A-share market, were down in the dumps, as I said. And so if you can't go out, it's like, I'm not buying these companies either, right? So they just weren't moving the needle. When we got reopening coming through, that kind of unwound quite at a very, very fast clip. And you're going, right, this travel company that was for a while was maybe only selling a few sort of train fares here and there is now got a billion-person market that it can sell overseas travel to. So someone like Trip.com went from just under $20 to just over $40 in the space of a handful of weeks, basically, and that's not even got to the levels from where it was at before. So people are quite have been quite bullish on this, and it's having this impact on sentiment in terms of the consumer sentiment on the ground, and we think that will play out in different stages, right? So the first thing is people are going to start going to cinema, going to restaurants and doing that kind of thing, getting back to life, your day-to-day life. Then they'll start doing other things like more services, so going traveling and all these such things as well. And it will just have a nice sort of overall impact on sentiment, in terms of spending as well, and the economy. So that's really been a big sort of driver, and it's got everyone refocused on Asia right at a period in time when the developed markets are going through a bit of a tough patch, right, for reasons that we all know. So that has been it's got the eyes back onto our part of the world. Now, what I will say is, as we're talking now, the easy money has been made. Right? And it's been this, as we call it, the beta play, right? You buy into something because you think the whole market's going up. Those beta names, particularly linked to reopening and consumption, it's kind of played out. So if you've missed it, you've kind of missed it, right? And so now it's about looking again and seeing.
Did you miss it?
No.
Yeah,
that's why I mentioned it. That's why I mentioned it. If we did miss it, I wouldn't have brought it up. And I'll tell you why we got it in a moment as well, because it's important to dissect top level kind of macro sort of political thoughts to bottom up stock picking, because that's really how you make money. But going to what we're doing now is the reopening plays have by and large played out, the obvious ones, travel companies and such, and now it's going, where's the next batch of money, sort of consumers' money going to? What could be the second derivative or third derivative beneficiaries, and can companies actually deliver? And it's about really keeping an eye on sort of earnings and such. Okay, so we took a view middle of last year that, take a 2-3 year view from where we were sat. Will China be open or closed? We said, well, it'll be open. Right? We don't know if it's 2 months, two quarters, but it will be open, because it just physically, it's going to be hard work to contain that many people who feeling the pressure. Then when we were talking to corporates, so you talk to airlines within China, they said, we're starting to sort of look at reopening international routes. Talk to the airports, listen, we're kind of starting to dust off the desks. Those sorts of companies are not doing it without a bit of a tap on the shoulder and told, start looking at this. Right? They wouldn't just, obviously they're always looking, but they wouldn't really make real proper moves until they get wind of, whatever channels that they should be doing it. And that to us was like something's happening. We don't know quite the timing, but this is one of these sort of validation points for us that things are reopening. Hong Kong was then reopened. Think of Hong Kong as a canary in a coal mine for China for a lot of things. And Hong Kong is like the bellwether for international markets and such. And I think, interestingly, I don't know what it would be, but the next things that happen, in Hong Kong, whether it's like different regulation or it could be something to do with markets and all these things, it could be a bit of a testing ground for what they might want to introduce in China, right? So think of Hong Kong as a canary in a coal mine for different things. So that was another validation point. And then you had the Congress, where President Xi was sort of reappointed. And of course, all the politicians stood up and said, we've done a great job with COVID, job well done. Of course they're going to say that. They're not going to stand up and say, well, isn't this terrible, right? Yeah. So they stood up and said, this is great. The markets, broadly, international markets, took that as China's doubling down on zero COVID. It will never open. So the first week of November was like peak trough, if you like. It was like terrible. People, it was like suicidal sentiment. For us, that was a time to top up more. And then we didn't know when the reopening would happen. Lo and behold, it did quite quickly after that. And the stocks have done quite nicely. But now we're in this sort of dust settling period.
We'll get to some of the individual stocks where if the beta plays moved on. I guess the question is, where do you find alpha now? But before then, do you have any thoughts on the property side of it?
Yeah. So if you wind the clock back a touch, right? So the property sector, if we go back 2-3 years, it was starting to become dominated. The growth of the sector was dominated by the private companies, the Evergrandes and the Sunacs and these sorts that, to be fair, were borrowing or they were leveraging up, basically. They were borrowing a lot of money to develop land and buy land and all these things. So it's creating a bit of a debt overhang. And it's a strategically important sector, right? For the economy to roll along nicely, the property sector has to be going along nicely as well. With the privately managed companies gaining more control, you can argue from a government perspective, it's starting to fall out of our hands. And so they introduced this policy called the 3 Red Lines policy. And the 3 Red Line policy, which came into effect 18 months, 2 years ago, was essentially you couldn't go over these 3 red lines in terms of like leverage and all these. It was essentially to keep debt down. And it was done in a way that dinged the private companies. right? And so they couldn't get money from the banks anymore, and so their funding sources were kind of drying up. You can understand where they're coming from and the intention. It just, the market, it wasn't messaged well to the market, and people got panicked, started to sell down the property stocks, and then at the same time, individuals were going and checking on their, their off-plan investment that they made. Private company hasn't got funding, so like, people would turn up going, look at this hole in the ground, like, what am I paying for? And then it just impacted sort of confidence in the property sector, right? So subsequently, what we have seen is the state-owned companies have come in and sort of, the white knights, and they're helping finish developments, they're getting new land, and we've seen a complete reversal in terms of market share from private companies to SOEs in the property sector. So essentially, if we were talking 3 years ago, about 2/3 of the sort of market sales in China were for privately managed companies and 1/3 SOEs. It's reversal now. It's a complete reversal. 2/3 state-owned companies, 1/3 private. Now, that's sort of the background, right? It's a long way of sort of going through it, but that's how how it's played out. What we are now seeing is sort of the bottoming of the market. So we've seen some negative price growth. I think it was on Thursday, a couple of days ago anyway. We saw the first sort of positive year-on-year price sort of data coming through for properties sold in the tier 1 and tier 2 cities. So in China, cities are sort of tiered, right? So the tier 1, sort of the Shanghai, Beijing's have sort of moved back into positive territory. But just before that, we've started to see a bit of a plateau in terms of downward prices for the secondary market. And interestingly, we're seeing more confidence in the secondary market in China versus the primary market, which isn't quite that common, right? The Chinese sort of cultural mentality is buy something new and not secondhand, but it's sort of changed a little bit actually, and people are a little bit more nervous on the new properties because they've seen, is it going to be finished? I don't know. At least a secondary property, I know it's there, and that's it. So we're seeing some bottoming of the prices. Demand, we think it will come back, but it will take time. And once it does, people feel wealthier again because it has a big impact on your wealth. And then you'll get people buy big ticket items like cars and things like that.
Yeah.
But, and so for now, consumption for us is small ticket items, using cash in the bank. And then in time, as property comes back, you might see some bigger ticket items being bought.
It is fascinating to think what the headlines were 2 years ago when this whole thing kicked off, and it was, like, is this going to tank the global economy, and what's the contagion? And 2 years later, it feels like
next question.
Yeah, next question.
It does. And my experience with Asia is that there's always the headline is always really negative. It's always really negative, and then you just scratch beneath the surface, and okay, there may be one or two sort of negative bits in there, but there's often some glimmers of hope, right? And so there's always an opportunity. And often when particularly international investors are panicked and they think, gosh, don't touch it with a barge pole, is when you can go in and you can make some good money. And it's difficult to do though, because sometimes you've got to just bite the bullet and go for it.
Yeah.
Well, let's move to opportunities and what's in the portfolios. So 46% of the fund is invested in China, which is overweight compared to the benchmark. But when we think about China, a lot of the Equity Mates audience think the big sort of tech companies, those big names, Tencent, Alibaba, Meituan, etc. But you're underweight on those companies. Well, you don't own them.
Don't own them at all.
There you go.
It's as underweight as you can be.
Can't get much more underweight than that.
Yeah.
Why is that?
Yeah, so regulation that you're aware of in the internet sector, you've probably maybe touched on this in past episodes, but if you take Tencent and Alibaba, they're effectively monopolies in there, or at least the most dominant forces in e-commerce for Alibaba and sort of platform messaging and gaming for Tencent. They were using that sort of, their monopoly powers, if you like, for data, and as you would, right? You're using it for so I've got this great data, and I can, Mr. Advertiser, I can, give you, I can
just like Western,
just like everyone does it.
Yeah.
But the other thing they were also doing is anyone that sort of even smelt a little bit like they were going to compete, they just used their size and sort of bought that up and coming company.
So like Western
Yeah,
tech companies.
exactly. And sometimes they mothballed that company. Sometimes they integrated it. And with that, there was obviously you come under regulatory scrutiny. And at the time, actually, when it first kicked off around November 2020, actually, it's when COVID first hit, the whole sort of premise, was trying to sort of bring the companies sort of somewhat into control a little bit, making sure that rules are in place around data security, data privacy, and then sort of trying to blow apart a touch some of the monopoly powers that some of these companies had. Depending on what seat you sat in, again, if you're top-down government, you might want to do that. If you like, create a bit more of a level sort of competitive playing field. From an equity perspective, that has happened. The playing field is more open than it has been. For us now, that means that there's more players in the marketplace in the internet space, and so you've got tons of different sort of platforms. You've got your JDs, your Meituan, your Bilibili, your Pinduoduo. There's tons of them. These companies make a lot of money through eyeballs, and so you've got 2 eyeballs, but you might have 25 apps on your phone. So, one, if you're a consumer, you might spread. I'll buy this product from these guys, or I'll use this one on this from these other guys. And then if you're an advertiser, you're also thinking, oh, geez, right, okay, which one do I go with? And so with that, we think that the businesses are sort of structurally changed, and some of them still make money, but not to the degree that they ever did. And if they did, then they're straight back in the regulatory spotlight again. And so for us, there's a little bit of a cap, if you like, in terms of what they can really sort of do compared to maybe the way you looked at them 2-3 years ago. And so we're steering clear. But if they get cheap enough, maybe.
One more question on China, and then let's move to other parts of Asia. But I feel like if we're going to ask you what you're not buying in China, we have to then ask you what gets you excited in China. Sector or industry, or if there are any specific names.
Yeah.
But if your fund is overweight China, as Bryce said, but underweight some of those big tech names, what are the sectors that stand out?
Yeah, well, first of all, if you look at China, there's different parts of the China market. You've got the A-share onshore market. So that's the Shanghai and Shenzhen indexes. You've got the Hong Kong H shares, which most international investors would be sort of aware of. Then you've got some of the US ADRs, so Chinese companies listed in the US. And so for us, we find in the A-share market is really interesting. It's less well understood. It's less well researched. And there's 4,000 companies listed in China. And you only have to own a handful of them, and you can make you can make some decent money. So we like the A-share market first and foremost, and because of the swings in sentiment that happen there, you can get some real interesting sort of value opportunities for good businesses that people just don't own because it's a Chinese onshore company, and they don't understand it. To really truly understand that, though, you need the team, so you speak Mandarin and they can read the reports and they can get the nuances. And so that for us, we think is a bit of an edge. Which companies? I can talk for a couple. We've got Focus Media, which is a digital...
I saw that was your biggest holding.
Yeah,
Never heard of
10%.
it before.
So they do digital display advertising, right? Which essentially, the screens that you get in elevators and screens that you see in shopping malls, that's what they do. Right, it's not it's not one of these sort of like these businesses that you can't understand. It's quite an easy one to understand.
So like an O Media or a JD Deco in Australia.
Yeah, it's a bit like that actually. Yeah. And what they've done is they've got a lot of first mover advantage, and so they've got about 75 to 80% market share in that whole space, which is good if you can do if you've got it. And what we like about it actually is that once you've got your screen in an elevator, someone can't just stick another screen in front, right? And going back to my point on the internet companies, someone can the pop-up can be taken over by another company, by another advertiser. So for us, the Focus Media is a dominant player in its field. The elevator, what we call the elevator and escalator screen advertising, is actually gaining market share at a good fast rate as well. Going back to my earlier point, the advertisers are less enamored with online advertising, partly because of the reasons I mentioned, that there's just more platforms and so they're not quite sure who to pick. But the other one which is interesting is that consumer companies, something like China Mengyu Dairy, right, they do yogurts and milk and such. They're saying, well, we need a broad audience, right? We're trying to sell yogurts, anyone can eat it. Put it on a screen where there's going to be 10,000 people walking through, and sort of flash it and make it look fancy. People will remember it. But if you're China Mengyu Dairy and you're going to one of the platforms, what data can you give me? And it becomes a very targeted advertising way of advertising, and so the return on investment from an advertising perspective is actually lower. And so they're going to these screens. Of course, it got smashed, right? A couple of years ago, because the consumer sentiment I talked about, people couldn't go out.
Yeah.
And we're like, net cash on the balance sheet, a interesting business for when things do turn around and consumer confidence comes back. Dominant market share, which means it's got pricing power. Let's buy into it, and we did. And it's been, for us in the last few months, it's been a very, it's been very much a sort of a good sort of opportunity for us overall. The risks on that, of course, are, you've got to think about regulation. But if you're an advertiser for a billboard, essentially a screen, your regulation risk is quite low. The biggest risk is that your product, the guy does a product sign off and puts through an advertisement that's slightly risky or what have you. But that's minimal, because they should have the compliance in place, and so you've got less regulatory risk overall. And so as the economy bounces back, which we think it is, consumer comes back, we think we can make some good money on that, and it's not known. So it comes back into focus.
Love that.
It is known now.
It's known now.
For people listening.
And I'll show you, after this, I'll show you a picture of like how it kind of works. It's obvious, but it's quite smart how they do it.
Oh,
well.
yeah.
Yeah, it's good.
Great.
Another idea, if you like.
Please.
Going to the property sector. We don't like the developers. As I said,
I was going to say, you're a very brave man if you're coming on here and pitching a developer.
No, not developers, because partly because they're now SOE dominated, you want to be with the SOEs if you're going to invest in there. But problem with investing in state-owned companies is that they're not always managed for value, right? They're managed for volume and other purposes. So for us, not the great investment. But we like some of the building materials companies. So Beijing Oriental Yuhong, which sell, manufacture and sell waterproofing, so silicone that goes around your sinks and the membranes that go on your roof. They've got a big market share there. We like SK Shoe Paint, so a paint business. And what's interesting for us from a top-down perspective is we think that the property sector is sort of bottoming and could improve. But also from a company perspective, they don't really care which developer wins, which developer's finishing a project. So they're going to sell the paint to whoever it is. And so for us, don't try and guess, which developer's going to be the hero. Just buy the company that's going to sell stuff to whoever it is.
Yeah.
And so it's a really sort of a second derivative play on that sort of return. And there's a market share story here, gaining story too, because with the property sector going belly up, developers weren't paying the bills, right? And so invoices were going unpaid, and what we call account receivables were going up for building materials companies. And if you could stay still, if you had deep pockets and you could wear the pain, and it was painful, you're gaining market share because your competitors are getting taken out. And we've seen like Yuhong go from sort of around 10% market share to 20% market share in a couple of years.
Oh, wow.
And so mathematically, every time you see a development being built, there's a 20% chance that they're selling their products, their waterproofing to that developer. So for us, it's a sector everyone hates, and so therefore cheap. Again, cash on the balance sheet, and sort of hopefully we get a bit of a sustained turn in the property sector that will create a nice tailwind. So it creates about 4.5-5% position in both SK Shoe and Oriental Yuhong in the fund.
Nice. So Gary, outside of China, you've got geographic exposure in Taiwan, Hong Kong, India, Netherlands, which we'll get to. Not sure why that's in an India fund. Maybe a dumb question, but South Korea, Indonesia, Malaysia, the list goes on.
Yeah.
So outside of the two superpowers, China and India, where else are you seeing real opportunity?
At the moment, Korea is interesting in terms we think there's a bit of a turn in the tech cycle that's coming. We're seeing broadly across the tech cycle, the inventory sort of numbers are improving. If you're talking about like memory, for example, the inventory has gone down from roughly 10 weeks to 8 weeks. So it's on a sort of an improving trajectory, but it's not a straight line up, right? So you have to be aware of that. But with the valuations that they were trading at, they're not anymore, but the likes of SK Hynix, which is a memory player in Korea, was a few months back trading at 0.7 price to book, which in historically was a slam dunk buy.
Yeah.
You kind of close your eyes and you're going to make some money off of it. It's fortunately, in a way, it's popped and it's now not as cheap as it was. But for us, we think that the tech cycle generally is somewhat improving. Again, as I said, there's a global demand environment to keep an eye on, so which we have to keep constantly checking. But there are signs of sort of life, if you like, on those. And what we found historically is that these semiconductor companies tend to move around 2 to 2.5 quarters before the business improves. So if you buy on the news of the business actually being positive, you probably missed a good sort of 2 quarters at least of decent returns. So we've been buying into those areas. So SK Hynix, smaller position in Samsung Electronics, same story. Memory really moves the needle there, and you mentioned Netherlands, ASML plays into that.
Yeah, so how does a Dutch lithography company get in an Asian fund?
They just want ASML.
Yeah, I mean, who doesn't want ASML?
Yeah. Look, it's quite simple. There's a couple of things that happened. One is we're talking to the TSMCs and Samsung and SK Hynixes. Said all of them, sort of a straw poll. What concerns you in terms of if you look across your sort of supply chain and your value chain, and they're like lithography. Right? If something goes wrong, with lithography, we have got no other option. It's ASML.
Yeah.
Okay, right. Very good. 81% or so, just over 81% of its EBIT comes from Asia.
Yeah.
It's EUV machines, as they're called, which is the lithography machines. The new generation of them, the order book is full until 2026. Pretty much all Asian clients. They're listed in the Netherlands, but for us, there's a big, huge Asia sort of story there because the demand for their product is from the tech companies out here in our part of the world.
So is that part of the rules of your fund, that if a company's earning a certain percentage of revenue or profit from Asia, it fits the criteria?
Correct. Yeah, we have to get through, and I will say the strict compliance department in Australia, and we have to actually make a case. So we get the CIO sign off, of course, and it has to be. It's covered by the analysts. We've got to make sure we do all of that. Those cross checks, and then compliance in Australia give the final sign off.
Okay.
So they will, if they even sniff that it's a slightly kind of wishy-washy story, there's no chance.
Yeah. Okay. Yeah.
Is that the same with the benchmark? Would the benchmark have ASML in it as well?
No, the benchmark doesn't. So it's in the European index. Yeah.
Nice.
So does that mean, in theory, there was a while, I don't know if they're still doing it, but Starbucks is opening like 100 stores
a day?
I was about to say a day, but that's not
Yeah.
true. But they were just opening a stupid amount of stores, and all their growth was coming from China. If all of a sudden Starbucks was earning more from China from Asia than it was America, could then you make a case that it's in the fund?
In theory, yeah.
Not saying that it's there.
I know. I know what you mean. In theory, yes, but we also we have rules around how much we can truly take off benchmark. So if you start to go sort of beyond sort of 10-15% in non-Asian companies, then the brakes are put on as well. So that there are sort of guidelines around that as well, which we can't get past. And don't quote me on the exact number because I cannot remember what the number is.
Yeah. One of the advantages of active management, I guess.
Definitely. Yeah.
Especially in markets like this, I think.
Yes.
GEMs, those emerging markets, what was the G for?
Global.
Yeah.
Yeah, I think
Geographic.
that's always the challenge with emerging market indexes. At least traditionally, it's been a lot of resources companies, and it hasn't been the sexy up and coming companies. It's been sort of slow growing, established businesses, and so that's where looking at an active manager makes sense in a market.
Well, a couple of bits there. I mean, we are benchmark agnostic, right? In that the benchmark is there as a kind of a guide for everyone to kind of roughly what's in favour and not. But it's also, it's just something to beat, right, in terms of like returns. And I used to play football, not so much now, but the analogy I'll use is that if you as a team are playing to your own strengths and you worry about you should hopefully do all right. If you worry about the other team, you don't play your own game. And the same with investing. If you think about the benchmark and you look at it, you start to slowly creep towards it and you look like the benchmark. But if you can stick to your strength, which for us, we think is stock picking and knowing the companies, by taking a differentiated approach, you can beat the benchmark and hopefully quite handsomely. And that's sort of the way we approach it. It's there, it's interesting sometimes, but there are massive flaws with the benchmark as well, just how they classify companies. And you look at some of these and go, what is that a real estate business, or is that a conglomerate, or is that really an industrial company? It can be a bit misleading as well. So for us, it's there, it's a guide. It's a guide to beat, basically.
So Gary, we're almost out of time, but we have mentioned India a few times, and I've noticed that one of your biggest holdings was HDFC Bank.
Yeah.
And it's a company I want to ask you about because it's not the first time we've come across this company. We've had a few international experts come on and talk about it as like a really well-run bank. I guess tell us about it. Like why does everyone seem to love this Indian bank?
Yeah, you said it's well run. I mean, it genuinely is. It's a really well run bank. And the other things to think about is that with India generally, the demographics are getting attractive, right? So people are moving into the workforce. You're getting a rising middle class. So if you look at GDP per capita in India today, it's where China was 15 years ago. And I'm not saying the Indian consumer is going to be the next China consumer, but if anyone's going to give it a crack, it would be the Indian economy. And with that, as people get richer, as they start opening bank accounts, they move into the sector, into the banking system, then they start using credit cards, then they start getting small loans. And someone like HDFC Bank that's going to get and attract more of this sort of of this emerging middle class, it's this whole sort of rising tide lifts all boats sort of story. So for us, a really interesting company with that top-down sort of tailwind, very well managed, as you said, but they've got a lot of things in the in the background, like automated around the loan approvals. So take away the human error potentially that you might see in some other emerging markets in terms of building up your loan books and such. And so all of that combined for us makes it a really good company. However, for us in India generally, we're a little bit concerned actually with India. Okay. Valuations are quite high. And when you're trading at a really high valuation, you kind of got to be perfect. And what we've seen with like the Adani Group, for example, a few weeks back, it's not a perfect market. And so there are some sort of risks. And where we see a bit of a risk at the moment, and what we're keeping an eye on, ready potentially if there's a derating of the market to buy into, by the way, is just more on the consumer side, where inflation is starting to pick up a touch in India. And it is having an impact at the margins at the moment on end demand for consumer discretionary. And again, if you're trading at huge valuations, just a little bit of disappointment can drive some derating. So for us, we're generally cautious on the entire market. Got our eye on a few names that we hope fall into our price bracket, but maintain our position in HDFC Bank, which, as I said, is a really good company from our perspective.
I'm fascinated with India, and we're lucky enough to have another expert from Fidelity joining us a little bit later on in the year to specifically talk in more detail about India and emerging markets. So
we'll have to get those few names that are on your list off next time.
Yes. But Gary, thank you so much. It's been great to get out of the mindset of Western markets and America and Apple and all those other big Western names that we often gravitate towards, and understand more about the opportunities in Eastern markets and some of the nuances between the two. If you're listening along at home and you'd like more information about the funds, you can head to fidelity.com.au, and then there's a whole section on all of their Asian equities funds. Similarly, if you want to know more about active management and managed funds and how you can get access, they've got a Learn Hub on their website as well. We will also put link in the show notes with everything that we've mentioned today. One more question, Gary, before we do go. You are now officially in the running for Equity Mates Expert of the Year, which is voted by our audience at the end of the year. We celebrate products, platforms and people that really contribute to making financial markets more accessible for our audience. And by virtue of sitting here with us today, you are automatically in the running. To help our audience understand a little bit more about you, where would you put the coveted trophy that we would be awarding you?
Well, first of all, can you make sure you edit this so it is a good interview? Yeah. And I could be in the running. Second of all, go on the terrace out in the at home.
Nice.
Because we need a goalpost. So for my son. So we'll make a decent goalpost.
You're going to need to win for 2 years, aren't you? So you
Well,
have
that's
two
why I'll
posts.
come back next year.
Yeah. All right, we will hold you to that. And as we close out at the start of the interview, we played Biz Nerdle. You wanted to write a reply. Do you have one ready to go?
I do.
All right. Well, Bryce, should we go head to head?
Yeah, sure.
Okay.
If it's going to be like a Chinese waterproofing company, I'm just going to say there's no way I'm getting this.
Okay. Are you ready?
Yeah.
I have the biggest brand value within the whole beverage sector globally.
It's
I'm gonna get this wrong.
I'm not going to look it up. No, it's
K Choi Mu Tai, or what? However you pronounce it.
Kway Chow Multi.
Yeah.
Yes. Kway Chow Multi. It is. I should have made it more difficult.
Are you sure?
shouldn't I?
I actually did. I knew it was one of your biggest holdings, so that did
No,
help.
interesting. It's because multi, like champagne, you can only get champagne from Champagne in France. You can only get multi from multi.
It's a region.
It's a region, yeah. So
Okay.
Kway Chow and multi. It's the region in the town.
And they make
Baijiu.
The
Baijiu. So it
Baijiu, that's
cuts
it.
through the grease.
Yeah,
The food, you know,
okay.
it's,
Have you had to drink a bit of that while
Cuts through
you're
the liver
visiting
as well.
companies? Over there?
I've had my fair share.
Yeah, exactly.
53%. It's quite tough going. But,
Really?
right. And it's expensive, like for the bottle. It's
When you come back for Expert of the Year next year, you can bring us a bottle. Grace the.
Yeah, well, I'll have to get a loan for that. It's quite expensive.
Well, Gary, thanks for that. That's the first time that we've had a expert-led Biz Nerdle, so maybe we'll have to force some other experts into it as well. But thoroughly enjoyable. I know a lot of our audience would have taken a lot from the conversation today, so thank you very much.
No, thank you for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.